Hey guys, Bob Mortgage. I'm with Tamera Gaede with Lawyers Title, and we are here finally to talk to you guys about a lot of things going on in this mortgage marketplace, the real estate marketplace.
Everybody's going to want to know, where are we at right now? I get reports every day of the amount of listings that are going live, everything is going in escrow, and everything that's closing in my market area. And I have noticed last week and a half that it's gone from very robust in March to the beginning of
Yeah,
April. So let's talk about that.
yeah. I mean, I do feel like there has been a pullback, definitely within the purchase side of the marketplace, right? The purchase sale side of the marketplace. I mean, obviously, from a mortgage lending standpoint, title's probably feeling a little bit of this. We're having some positives with regard to refinances, just with obviously going into what we went into in this coronavirus pandemic and the pullback really caused some concerns, and the Fed started buying mortgage-backed securities, and when that started happening, obviously interest rates began to drop, and they dropped significantly. Where we were pulling in 30-year fixed rates at one time in the high twos, we're rolling in the low threes right now for most anybody that's looking to do a purchase on a 30-year fix to even refinances on 30-year fixed rate mortgages.
Yeah, that was
Definitely getting into the
questions
twos
is
on
what do you
15.
see as the current interest rates right now? Yeah.
Yeah, I mean, for someone that's looking to do that, I mean, yeah, we're doing them, 3.125. It's pretty real as it relates to the interest rate itself. APR is going to be obviously higher than that. Just depends on how many points they want to pay, if any, and then kind of how we structure the fee situation. But a lot of refinances, a lot of cash out refinances, people looking to pull money out of their home to either get ready for a little bit longer stay in their house. They need to have a little bit of cash, so they're tapping into that equity a little bit, or they're just using it to pay down some higher interest rate credit card debt that has some, carrying some higher payments, so that they can put that into their 30-year fixed mortgage and then spread that payment out over a longer period of time.
Everything, a lot of it, what I've been hearing is that investors are pulling back. So it's hard. It was hard to find deals. I mean, I know I'm always looking for another investment property, and to try to find those deals right before all of this happened was extremely difficult. The guidance that I'm getting right now is to hang on, because unfortunately, some of the investors are going to be able to profit off of what's going to happen next with all the unemployment and people not being able to pay their mortgages. So it's interesting that you've got investors that are able to find the deals right now, because there are still people that have to sell their house. They have to, for whatever reason,
Yeah, there's a reason they have to sell, and those are the individuals. I mean, the hardest part for an investor is probably finding the deal, right? So it's the bird dogging to find the deal. The ones that have that ability to do it, they either outsource it or just been doing it for a long time. They know the marketplace to look for the areas, and they may be able to pick up one or two or three
yeah.
properties that they could do it now where they maybe couldn't have done it pre Corona.
Do you think we're going to see a drop in interest rates again, or you think we're going to hold, or you think they might go back up a little bit?
I think they're going to go back up a little bit, but at the same time, I feel the Fed has put us in a place based on their buying pattern with the MBSs that they're going to keep them pretty low for a while until we have some confidence back in the market with regards to unemployment, with regards to job security, just getting people out there outside of their homes and socializing and spending money. I don't think they're going to let interest rates go up too quickly or too high in the short term. The Fed has pulled back a little bit on the mortgage-backed security buying, uh, and we haven't really seen a truly a negative impact in the interest rates that we would typically see if they pull back. So I think we're going to stay in that 3% to 3.5% range for a while. Maybe call it 30 days. This is a good long time, right? That's a good long time with interest rates being that low. When we were sitting, high threes to low fours going into this pandemic. So, we've seen a good half a point to a full point decrease in rates.
I was informed that minimum credit scores have changed, and how does that, what do they change to from, and how does that affect people trying to get a loan?
Yeah, so a lot of lenders did really create a just like what happened, in 08, 09 to the housing crisis. I mean, we did see a pullback with credit scores really quickly back in that day, and we saw the same thing today. This last couple of weeks, we saw mortgage lenders go from FHA 580 credit scores up to some went up to 640 and 680 on the minimum credit scores for FHA, VA, and USDA. The government's just not, they're looking at that. When you're looking at like people that are applying for a home loan, like new home buyers that are typically looking for the minimum down payment, 3.5% down payment. Their credit scores are, on average, about 50% of those are about 640 to 660 on the credit score range. So they immediately said, look, those are the ones that in that credit score range could potentially fall for this forbearance. So let's go ahead and increase our credit scores to a higher number, than the 580 or the 620. So we did see a lot of companies adjust. Now, like for our company, Benchmark, what we did was we said, let's pause. We did make the adjustment, and then we came back and said, look, we got to get back to, good credit score, credit underwriting, which is more than just a score. It's looking at the overall borrower. So we said, okay, we'll go back down to a 620 credit score, but we want to make sure as originators that we're willing to loan our own money, right? If we can say we'll lend our own money, then we should ask our company to loan the money as the mortgage platform, and then we're going to service those loans. So we have to make sure that if we're making a loan at 620, that the client has has some reserves, has a good debt to income ratio, that we're looking at it kind of like somebody would look at a matrix that says, okay, is the reason that they're at a 620 or 625, is it tied to an isolated incident within their credit pattern, right? Is it something that happened over a 2-3 month period and everything in the last 2 to 3 years has been clean? Or is it something that is a pattern, a habit that developed? And that pattern or habit that's developed over time will eventually and ultimately repeat itself. Therefore, somebody that's had 15, 20, 30 late payments over a 3-year period more than likely will continue to have those lates going forward, and those are the ones that may potentially file for that forbearance. Which, as a servicing company, we don't want to take that on, right? Because as soon as we do a loan and then they go into forbearance, then we're still on the hook making payments to the bondholders and investors, and we're not getting any income coming in from the mortgage payments.
How do you see all of this kind of shaking out after the shelter in place orders are lifted and people can kind of
Yeah.
get what they were doing?
Well, I mean, we have 160 million people in the labor force, right? And before coronavirus, we're sitting at about 3.5% unemployment, which was roughly 5.6 million people unemployed. Over the last 3 weeks, we had about 17 million people file for their initial jobless claims, right? So
Incredible.
that's putting us right. I mean, that's a 23 million people that are unemployed right now, based on those statistics. Well, if you look at what 20% unemployment would be, that'd be about 32 million people unemployed at 20%. Now, the highest unemployment we've had was 24.9% during the Great Depression.
Hmm.
So, I mean, yeah, we have. I mean, is 20% realistic? Sure. I mean, given the fact that we're already at 23 million unemployed, and we're only talking about the first 3 weeks of this, if this continues, we could see definitely a 20% unemployment rate. So, the challenges that we see coming out of this is, lending will look at that and say, okay, we need to make sure that the people that are reentering this workforce are now more stable and are on their job for, call it, 6 months, not just 30 days and let's go buy a
Yeah.
house. We need to make sure that they're on their job for 6 months so that, we have some stability around their job, around their income, so that we're willing to make loans.
Stay safe and take care of your family. I'll talk with you soon.
Take care. Bye bye.